This is Phil Ferguson, and you are listening to The Phil Ferguson Show. This is part one of what I think will be a six-part series. Yeah, six-part series. It is a update, reproduction, re-verification, I guess, of some of the things that I talked about almost exactly 2 years ago in August of 2020. It is now midsummer, I guess, of 2022, July, and this might roll over into August, of course. And I'm going to talk about the Polaris Plan. I often talk about scams, ripoffs, and from time to time, how to invest. Well, these next six segments, these next six episodes, are going to go over the plan from beginning to end, kind of in a formatted, detailed way that you could listen to these six segments and get a pretty good idea of how it works, how you could do it. And it's not rocket science, but there is a lot to know. And you can do some of this, maybe even all of it, if you're really into it on your own. Of course, you can hire somebody if you wish to. That somebody could be me. Polaris Financial Planning is my business. And of course, you can email me, phil@polarisfinancialplanning.com. I'm going to start off with my regular book recommendations, 4 books that I suggest that you read. And then we'll kind of give an overview of how the Polaris Plan works and what it's for, what it can do, what it might do, what it might not do. And you can take pieces of this and use it. You can take all of it and use it. This is all just me sharing my thoughts. Of course, as you hear regularly on the show, this is not specialized. No, it's not customized. It's not independent. No, it's not individual investment advice, I guess is what I want to say. It's not for you. These are ideas. Learn from these ideas, share these ideas, take the parts that you think might fit you. And if you're really not up to it, find an independent financial advisor that can help you with it. You could even have them listen to this and see how it fits in compared to what you're looking for. Now, if you're looking for an investment advisor, the 2 things that I tell everybody, and this is real straightforward and easy, make sure that they're willing to put in writing that they are a fiduciary advisor. I think they should be fee only. I think that they should be paid only by you. People work for who they are paid by. So if they suggest some fancy schmancy product that you don't understand, first of all, if you don't understand it, don't invest in it. You've got time. Don't panic. Don't do anything crazy because they tell you it's going to go away. But if they say it doesn't cost you anything, that's when you should be the most scared. Because somebody's paying them. They're not doing it for free. You don't do your job for free. They need to get paid. They want to get paid. And you want them to get paid. You just want to know how they're being paid. Are they being paid by you? If they're being paid by you, well, then they work for you. And they do what's in your best interest. One of the other little catchphrase things that I tell people is that my fee is a percentage of assets under management. And as your portfolio goes up, my fee goes up. And so you get to put my greed to work for you. And that's kind of the whole idea, is that the better you do, the better I do. That's the goal. You don't want someone who makes 10 or 15% one time selling you some shit. And then after that, you're an annoyance because they already got paid their commission. Now, every time they talk to you, you're wasting their time or keeping them off of the golf course. So anyway, the books. There are 4 books. I talk about them regularly, but I figured since I'm kind of doing everything here with this show in these next 6 segments, we got to include the books. The first book is The Richest Man in Babylon. It is probably close to 100 years old. It is not woke. Some of the topics they discuss and the relationships between different individuals, you may be a little bothered by it. You may be a little triggered by it. Hopefully it's not that bad. But when it talks about investing in money and how to think about money, it's really good. It is really good. No one teaches you how to think about money because nobody makes money doing so. Matter of fact, they probably are better off if you don't know a fucking thing and you just go to them and then they can sell you some shit and make big commissions because their best interest might be served whether you do well or not. And that is something that drives me nuts. But The Richest Man in Babylon, because it's old and out of copyright, I think that's how this works. It's like a $4 book. It's a 2 to 3 hour read. I've been told, and I did look, I don't know if it's still up, that someone read it out loud on a YouTube video. So you can get it that way. You can get it in Kindle, paperback, audiobook. It's real cheap. It's easy. It does get a little boring in the middle, at least I thought, and then it finished strong. So that was kind of nice. And that is a foundational book to get you to think about why you need to save. If you're someone who's already saved up a couple of millions of dollars, maybe you don't need this book, but it doesn't hurt either, and it's an easy read. And I do very, very, very strongly recommend that everyone start at book 1 and you work your way up to book 4 in order. Don't skip around. And I'll cover some of the reasons why this is here in a minute. The second book is called A Random Walk Down Wall Street. And I think the second and the third book, they're both 40, 50 years old. I am not a big fan of new stuff. The things that come around that tell you you're going to get rich quick. There's a whole new world, a whole new way of investing. Fine, maybe there is. And maybe I miss out on something really cool and trendy. I'm okay with that. I know that people that follow some of the basic stuff are going to make a lot of money. And it's going to work. It does work. It will work. It has worked. So I like that. Maybe it's the most boring investment advice in the world, but I see myself as the tortoise in the tortoise and hare fable. Slow and steady. Start early if you can and save as much as you can. Keep your costs down. Keep your taxes down. Just keep plodding along. When the market goes up, you add money. When the market goes down, you add money. And in the end, you have a really good probability of becoming rich. My definition of rich, by the way, is that you have a sufficiently large enough portfolio that you no longer have to work for the purpose of earning money. You may choose to work, but it's your choice. Totally different than the necessity to work. A Random Walk Down Wall Street. And again, this book has been revised multiple times. So look for one of the newer, if not the newest revision. And you can check in your favorite bookstore or online shopping website, whatever we want to call those. And that book teaches you a lot about these are stocks, these are bonds, this is how mutual funds are formed and how they work, this is how the economy works, this is how the government affects markets and different things, and these are interest rates, and a lot of the foundational words that you need to understand what comes later. Because if you read the fourth book in the series and haven't read the first 3, you don't really have a framework to understand what you're even reading. That's the reason for the books in order. Even if you consider yourself more of a expert in the subject matter, reading the 3 books before you get to the 4th book, it'd just be a refresher, and you'll be able to go through it quick. If you're younger, if you're newer to this stuff, you don't have to go through it quick. The first book, honestly, a couple of hours if you're a quick reader, spaced out over a couple of days if you want to break it apart, that's fine. The second book, if you're new, weeks, maybe a month or 2. Same thing with the 3rd book, and maybe even the 4th book can take you months or longer than a year. Especially if you're, say, 25 or 35, you have 20, 30, 40 years of investing. Take the time to figure out how all this stuff works. Again, the second book, A Random Walk Down Wall Street. The 3rd book, called Winning the Loser's Game. The nice thing about Winning the Loser's Game is it walks you through why index funds are so amazing, why they crush everything that's not a mutual fund, at least on average. And one of the gists of the whole idea with an index fund, particularly a stock index fund, but this is also true with bond index funds, with the stock market is the net knowledge, net experience, net wisdom for whatever it's worth, valuable or not valuable. The amount of people that want to buy things, the amount of people that want to sell things, there is some supply and demand, a lot of supply and demand pushing the prices of stocks. One nice thing about a stock, and the same can be said by a bond, is that there are different methods to calculate how much an individual stock is worth, and they can vary quite a bit, the different methods and what different people think IBM might be worth or what Tesla might be worth. But at least there's some stuff that they can point to. There's factory, there's patents, there's income stream, there's revenue, there's all kinds of things that you can point to and utilize to figure out what a stock might be worth. I find it very frustrating when someone says buying stocks is like gambling. Well, if you mean that the prices can go up and the prices can go down and you might do well and you might not do well, all right, there's some merit to that comparison. But in gambling, it's chance. With stock picking, it shouldn't be. I mean, if you're throwing darts at the wall and picking your stocks that way, it's kind of like gambling. But even in that scenario, every time you gamble, you lose money, on average. Every time you invest, if you're doing it with even some moderate effort, every time you invest at the end of the year, you should have, on average, more money. With gambling, on average, you have less money every time you participate. And with investing, generally speaking, on average, you have more money every time you participate. So, yeah, there's some up and down to it, but investing should be done with a purpose. And like I said, companies have some values. They own things, patents, copyrights, inventory, factories, contracts, a lot of different things you can use, like I said before, cash flow, to create an estimation of what a company might be worth, and then divided by the number of shares, and you can come up with a ballpark idea of what a company is worth per share. With something like gambling, that's not a possibility. Something like cryptocurrency, it's not a possibility. The only reason that you put money in a cryptocurrency is hoping that at some point in the future you sell it for more than what you paid for it. Well, why is it worth more than what you paid? I don't know. It's beyond me. But if there's people that can do that correctly, maybe they can make some money. It's something that I don't do. It's something that I recommend vigorously against. The fourth book. So we have, again, recap, Richest Man in Babylon, Random Walk Down Wall Street, Winning the Loser's Game, and the fourth book is Common Sense on Mutual Funds by John Bogle. And so once you have all the basics and understanding of a lot of the words and how things relate to each other, Common Sense really brings it all together. It is a difficult book. It has a lot of data, some statistics, graphs, charts, the kind of stuff that I love, and maybe a lot of you love as well, and you're going to enjoy the book. But if you're really brand new to investing and you pick up Common Sense on Mutual Funds and sit down and try to read it like it's a Harry Potter novel, you're not going to be happy. You're not going to absorb very much of it. Take your time with this book. The first three books, if you want to have it as an audiobook, great. If you want to have it on an e-reader of some kind, great. If you want to have it on paperback or hardback, great. This fourth book, I insist that you have it in physical form. You're going to want to take notes. At least you should take notes. And again, if you're new to this book could take you a year or two to really process. Treat it like a college course or a couple of college courses, and take your time through it. If you feel like you're just not getting it, that's okay. Set it aside, come back to it a week later. It's not a race. You don't have to get through this book as fast as possible. The point is to understand the content for your own personal benefit. And we are talking about huge amounts of money in the long run. And I recently did, for one of the episodes previously, something about instead of making 6%, if you can make 10%, 6% is often something around what the average investor makes while the market makes 10. $100,000 invested 20 or 30, I think it's 30 years later was the number that I did. You can talk about having something under $1 million or over $2 million. It's a huge difference, really. Phenomenal amounts of money you can get in the long run by doing better each and every year. And a lot of the stuff in this plan talks about that. So those are the books. Now, as far as the plan, this segment is the big overview. There's a lot of things that I do in the plan or think about or I like to do. And there's a lot of things I don't like to do. The things I don't like to do are not necessarily wrong, but they are things that I don't like to do. And I have reasons for them. And I think they're good reasons, but who knows? This is not the only way to invest. So the first thing, of course, is that I use index funds. If you don't know what that is, look it up or reference those books that I've talked about or go search. Great places for information, by the way, from a general standpoint. Investopedia, it's kind of like Wikipedia for investing. Absolutely fantastic. And boy, I think almost every time I've ever gone and read something there, they're spot on. I don't know of any bias that they're promoting one agenda over another. I think it's just information. And of course, they have ads on the website. Another great place is morningstar.com. For free, you can learn a lot about possible investments that you might buy. So there's some other resources for you. Another thing that I mentioned a few minutes ago, it's very, very important. Do not invest in something that you do not fully understand. If you don't fully understand it, there's a good chance someone doesn't want you to fully understand it. You should have a pretty high level of understanding what you're investing in. If that means you need to spend a year to read the first 3 books anyway, before you invest and your money sits in cash for a year, fine with me. It is perfectly fine to skip a year of income or of appreciation if that means you have a higher probability of not getting fucked by someone that tricked you. Take your time. Learn over time. Get better over time. The big reason for index funds versus managed mutual funds is the dramatically lower expense ratios, the dramatically lower tax consequences for any money that you have in a taxable account. If you're in a tax qualified or tax privileged account like an IRA or a 401k or a 403b, fine, you're not paying taxes, but you still want the investments to be efficient so you can squeak out a little bit more money every year. Another thing, of course, is how do you kind of mitigate risk? So my plan is not to make the most money in any given time period, but hopefully to equate to maybe to eke out a little bit of an advantage in the long run while trying to keep some of the volatility from happening. Volatility is the mathematical term. There's the mathematical calculations. You can calculate volatility, but it's often spoken of as risk. And one of the sneaky things is sometimes risk doesn't look like it's there until it's too late. So knowing how different types of investments work is really important. I generally use bond index funds and stock-based index funds, with the one exception of the Vanguard REIT index fund, which does allow itself to actually invest directly in properties. So there is a little bit of something different there. Again, if you've listened to only a few shows, you know, cryptocurrency, stay the fuck away from it. That's my opinion. You don't have to follow my suggestions. Commodities, wheat, oil, gold, all of that stuff, historically, in the long run, returns about inflation. So 2, 3, 4% in normal times, not the 8 or 9% that we have in 2022. But generally speaking, commodities return about inflation plus a little premium, but they're wickedly volatile. And you can have a commodity fund that goes up 70 or 80% in 1 year and then down 70 or 80%. So it's a very small net return with a whole lot of volatility. So that's the opposite of what I'm going for. And to succeed in something like that, you have to know when to get in, when to get out. I don't claim to. Matter of fact, I think one of the biggest perks of what I talk about is the acceptance that I don't know what's going to happen. So by accepting the idea that I don't know what's going to happen, what I have to look at is a long-term track record of how things work and some information going forward about what might happen. I don't know what's going to happen, but there's some things that you can see that when you know enough things that you can kind of get an idea what might happen going forward. One of those things, and I actually went back and listened to the episodes in 2020, and I had talked about bonds, and I'll get more into that in the bond segment, which is probably what I'm covering in episode 2 or part 2 of the Polaris Plan. Really long-term bonds have a huge amount of possible volatility if interest rates change. And I'll go into that more later, and I've talked about that more in other segments. So that can be a really big deal. Understanding how that works, and if you understood 2 years ago that interest rates were at historic all-time record lows, and there's really not much room, if any room at all, for them to go down, and there's only the possibility for them to go up like they have, we were all very lucky. Anyone that listened to my plan as laid out 2 years ago, the clients that I have now, and maybe for the last 2 years, they might have complained, well, maybe for a year, they complained about not making the bond returns that some other people were making. But now that has come home to roost with a dramatic increase in interest rates and some big losses in bonds. Really conservative bonds down 3 to 5%, way further down than I expected. But the long-term bonds, some of them, and junk bonds have lost 20, 30, 40% in a year and a half. If you knew what you were doing and you had that as a little bit of spice in your portfolio, that's fine. But if you had half of your money in bonds, thinking that half of your money was relatively safe, and now you lost 40% of half of your portfolio, the part that you thought was the safest part has lost you more than the part that you thought was risky. Wow. I could see how that would be very upsetting to people. So that's part of why we're doing this, to talk about it. Another general philosophy that I have is a very slight contrarian philosophy. Generally speaking, sometimes in the U.S. stock market particularly, things that do well keep doing well until they don't. And so if a part of the market, a part of the U.S. stock market does better than other parts of the U.S. stock market, over time, gradually, I tend to hedge against what has done really well. I will give you an example, and we'll talk about that more in the U.S. stock part. When large cap growth makes 10, 15, 20% per year for several years, I get nervous. So I will reduce the amount that's in large cap stock. And specifically, I will reduce the amount that's in large cap growth stocks. And over the last couple of years, I've been doing that. Depending on when you listen to this, keep in mind that this is recorded July of 2022, the conditions may be different. So it's important that you understand the philosophy behind it. So in the past 10 to 12 years, not counting the last year or so, large cap growth stocks have done better than other segments of the market, the U.S. stock market. And as a reference, and again, it's a whole nother segment, but for the United States stock market, if you have enough money, I break it up into 6 different components: large cap growth, large cap value, mid cap growth and value, small cap growth and value. So those 6 segments all return about 10% per year on average in the long run. And what happens in any given 12-month period or any week or any month could be anything. Anything could happen. But in the long run, they all do about the same. But when one segment gets away from the others, does much better, you can trim it. If a couple segments fall behind, you can fill it. And that's done by another key fundamental piece of this entire plan, that is rebalancing. And people ask all the time, how often should I rebalance? Generally speaking, for most people, 1 year is a pretty good guideline. If your portfolio is really small and you only have a couple of funds, it might not be necessary to do it in 1 year. The nice thing is that you can also rebalance by adding money. So if you have $10,000 and you add $5,000, you can look at your plan and you can rebalance with the new money. Say you only have 2 funds. Well, you say, what is my plan? What is the allocation that I want to have? And the new money fixes that. So you don't even have to rebalance once a year. You just continually rebalance as you're adding money. It's also something you can do. You can rebalance by taking out money. So if you're in retirement and a couple of stock funds just do better than everything else, well, that's probably where I'm going to lean towards taking the bulk of the money out of. And you're automatically rebalancing when you're adding and taking money out. But if you're not in the mood to add a whole lot, or your portfolio is, say, 2 million and you're adding 10,000 a year, well, you can't rebalance much with the new money. And once a year, rebalancing inside the account is likely a good idea. If possible, you want to do that in the tax sheltered accounts. Again, IRA, Roth IRA, 401k, that kind of thing. If you can't, you have to think a little harder because there might be tax consequences. And consider those. Consult with your advisor, consult with your tax professional as to whether you should rebalance, or maybe you do a partial rebalance. I don't know. It's all shades of gray, so you've got to think about it and think it through. But it's really important to understand the fundamentals. What I was talking about, the large cap growth, and even now as I'm talking, and I'm going to look at some of the data from June 30th of 2022. And again, everything here I'm looking at Vanguard index funds. For the 10-year period ending June 30th of 2022, the large cap growth fund has an average return of 13.87. I'm going to call it 14% per year. That's fantastic. Absolutely crazy fantastic. Now, if you had looked at that number a year ago, looking back 10 years, I don't know what the number was, but it was a lot bigger than that. In the last 12 months, again, ending June 30th of 2022, that fund is now down 21.87. I'll call it minus 22. If you check on a different day, you're going to get a different number. So again, this is as of June 30th, 12-month performance. Not year to date, but 12 months, down 21.87, minus 22%. The large cap value fund, which we've been slowly making bigger relative to the large cap growth fund, it's down 1.9. It's down 2%. So when the large cap growth was winning, and we scooped a little bit off, a few percent here, a few percent there, we're talking 6 months, 12 months, 18 months, a few percent adjustments. So I see it as not market timing, but market-based adjustments, because I don't want to completely ignore the reality of what's going on, but I don't want to jump in and out during the day, during the week, during the month, maybe even not even during a year. But from time to time, one should recognize that certain parts of the market are getting way ahead or are falling way behind. And again, those 6 segments have a trait, and we can argue over the mathematical term of it. I think I'm using this correctly, but what's important is that you understand that they experience regression to the mean. And so the longer out you look in time through the past, 10 years, 15 years, 20 years, the closer the performance of these funds is. As an example, as I mentioned, the 10-year performance of the large cap growth fund, 10-year performance, 14% per year. The large cap value is 12% per year, a difference of 2 percentage points. If you go back further, 15 years, 20 years, that variance gets smaller and smaller and smaller. And then sometimes in the short term, and I'm weird this way, short term for me is 3 to 5 years. Some people's short term is this afternoon, but for me, a few years is short term. In a short term, you can have a pretty big variance. As an example, the 3-year performance of those 2 funds is 11.6 versus 8.6. So 3 percentage points different. But then in 1 year, the difference is 20 points, minus 22 versus minus 2. Those big differences are exciting because that is something that you can use to adjust into. So when large caps do better than mid cap and small cap, I want to have a little bit more money in mid cap and small cap. When growth does better than value, I want to have a little bit more money in value than in growth. This can result in you underperforming the market if the next calendar year or 2 or 3, the same effect continues. So if a part of the market does really well and you adjust out of it, and then it does really well again, you've now moved some of your money away from where everything is doing really well. But then you can get these occasions here where the difference between growth and value is pushing close to 20%. And you are in the right place in the right time. And by the time you notice that this has happened, it's already over. So that's the slightly contrarian view. That is the adjustments, but not market timing view. We have index funds, we have stock index funds, we have bond index funds. And again, you can rebalance with new money. You can rebalance by taking money out. So whatever has performed and fallen behind its allocation that you have in the plan, whatever's fallen behind the most is where you add a bulk of your money. If you're on the other end of the spectrum and you're in retirement, whatever has done the best is likely where you're going to want to take out at least part of the money. You can take it from multiple positions. A couple other ideas that are involved with the plan is the idea of clarity and granularity. When you buy an average managed fund, you can buy a growth fund, an income fund, a growth and income fund, aggressive growth fund, a dividend yield fund. I'm talking about stock funds here. All of those names are a marketing gimmick. They don't mean anything in mathematics. They don't mean anything in probability. It doesn't necessarily give you any guidance to what the mutual fund manager is going to do. You can also have a problem where you buy 6 different managed stock funds in the United States and find out that all 6 of them, like 30% of all of the money, is in Microsoft, Tesla, Facebook, Amazon, Google, etc. And so again, now all of your eggs are in one basket. So you don't have the clarity unless you really dig in to see what you own. And you don't have the granularity where you can make any of these adjustments. This is one of the reasons why I adore the Vanguard index funds. Now, there is some overlap between the funds because sometimes a stock moves from one category to another, and the mutual fund managers have to decide how meaningful and how quickly do they want to move that stock from one fund to another fund. So there is some overlap, usually only a few percentage points. But by owning those 6 different stock funds, by owning bond funds that are very targeted, you can see exactly what percentage of your portfolio, for example, is junk bonds. You can see what percentage is small cap value. You can see what percentage is REIT. You can see what percentage is in a specific international fund, and you can make those adjustments. When almost everything in the market is down 10, 20, 30%, wouldn't it be fantastic to have an investment like the large cap value fund that it looks like here is actually the best performer over the last 12 months? If you needed more cash in your portfolio to spend money out of, well, now you could take it out of there. Where if you're just in generally managed stock mutual funds, they're probably all down. You don't have that opportunity. This is a phenomenally valuable thing to be able to do with your portfolio. And again, you can have a plan that's different than the plan that I use. But I think it's really important, and maybe even more important than the specific plan, is that you have a plan. So read the books, learn how things work, create a plan, use index funds, stock index funds, bond index funds, U.S. domestic stocks, international stocks, whatever funds you want to use, create your allocations, and keep an eye on it. Maybe it's only once a year. If the market suddenly moves 20% or more up or down, you can rebalance again. You can rebalance before the whole year is out. That won't bother me. Might be a good idea. But it's something, you kind of have to, it's like a plant. You got to keep an eye on it. Make sure it gets enough sunlight, but not too much. Make sure it gets some water, but not too much. Have a plan, follow your plan, and learn more about the markets as you go along. And hopefully this all comes together. So I think that provides a really good overall foundation for how it works, why I do it, the books you can read to learn more about it. And I'm going to wrap up part 1, and that's all this is. The whole episode was part 1 of the Polaris Plan, and I hope to have 5 more. I might add in other segments if something else comes up or I get an interview that I want to share with you. But hopefully the next 5 episodes of the podcast will have the next 5 parts of the plan. And that way you can reference it, or you can share it, you can list it, you can tell somebody else which shows to go to get kind of a quick and easy way. And by the fact that this took me over 30 minutes, hopefully all of it is under 3 hours, fingers crossed, under 3 hours. But, it's a lot of good stuff. Maybe I could make a book out of it. I don't know. Maybe I could sell a few copies. Who knows? But hopefully it's useful to you in some small way. So I'm just going to wrap up with that today. If this episode has created more questions for you, that's awesome. Send me an email, phil@polarisfinancialplanning.com. If I get it in the next week or two, when I do the other segments, I can elaborate, clarify, or correct whatever I fucked up. So let me know. I do hope to see you out there in the world someday soon at a conference or somewhere. And if you do see me and I don't recognize you, please feel free to come up and say hello. Until then, ciao.